So much more to yes, thank you, Henry, for recording. That's good. So what we're going to do today is a little bit different in terms of our approach. We're not going to do breakout rooms, and we're going to focus on kind of like just more of a Q&A as we go through today. So this is our final one, and I really want us to focus on what do you do with these ventures, with or without City of Melbourne, or involved in getting through the next stage of the application. Now this has been helpful for training, for getting the canvases done, refining your value proposition, trying to make the very best possible application. But I can talk about this as we go through. This is very much the beginning of a journey, and even if it doesn't work on this one, there are so many other avenues to go through. And I often think about this as like American Idol, or Britain's Got Talent is actually the person that often it's not the one that wins that becomes the most famous. It's the ones that come in second and third and fourth who are very, very good. Just didn't quite make that one, but they don't get pigeonholed. So anyway, that's a kind of analogy that I kind of like to use also because it makes you feel better if you don't get through. Now, of course, if you get through, even better. But it's all about trying to not worry about it. Okay, cool. So this is what we're going to talk about today. Funding, scaling, and thriving is what we're going to cover. Here's our sort of setup for today. So we'll talk about funding. We'll spend most of the time talking about that, and then a little bit on challenges of scaling, and some important stuff on the journey and what surviving and thriving sort of looks like. And then we're very lucky to have Monique Andrew join us at 12:30. And Monique is long-time sort of management consultant. I think she's done hedge funds. She's done a bunch of different investing, but now she heads up Trewella Climate Capital. So she's a really interesting person to have on here. So I hope that you've come up with some excellent questions to ask Monique, or even not even excellent questions, just any question that you want to ask around funding and what do they look for. So think about this as your opportunity to essentially have a one-on-one AMA with someone who is on the other side of the table. And so oftentimes we as founders and entrepreneurs arrive at the table to talk to a capitalist or a venture capitalist or someone who's a funder, and all the ideas are in our head about what they want. But actually quite often they want something completely different. So this is an opportunity to ask her. So I've already spoken to Monique this morning and said, hey, this is a great group of amazing entrepreneurs at different stages, but all with amazing ideas and lots of energy. And she said she's very happy to have any kind of open questions. So you can ask her anything. That's why it's called an AMA. Ask me anything. Ask her anything about what she sees in her work. I also want to sort of say for today, you can ask me anything as well as we go through. So I'd like us to stop. If there's something that's coming up, you want to ask a question straight away. We know each other enough now. Stick your hand up. Henry's going to keep an eye out. I'll keep an eye out. Put your hand up using the little emoji thing, and we'll just kind of attack it as we go through. All right, we've got 55 minutes. This is not about me giving a lecture. I really want us to open up and talk as we go through this. So let's dive in. Funding. Okay. It's the thing that we think about so much when we're trying to get a company off the ground. Many of us have done jobs at the same time as we're trying to get companies off the ground. You're working your 9 to 5, or you're working whatever that is, and you're trying to do it on the side. And you're at the same time trying to give everything to everything, and it's just not possible. So that's what we're going to cover this in a bit of this morning. But I just wanted to kind of open up with this, and that is that this is analysis from this year, but about last year. And it's interesting to see where the demand versus the supply of innovation sits. What I mean by that is who's buying the innovation. What I mean by buying is who's investing in it and who is creating those innovations. And so what tends to happen is we sometimes have a mismatch on what funders want to fund and what entrepreneurs want to build. And so buzzy topics. This is from Climate Tech Venture Capital, CTVC. Definitely worth checking out their website. They've got loads of great resources. It's probably one of the best resources I've seen for climate tech capital in terms of the research that they do. Anyway, energy, obviously a massive vertical, and has been for a long time and will continue to be, because there's a couple of reasons. A lot of it is mature technology, so it's easier for capitalists to invest in. We can talk about that, but it's also one of the major wedges of emissions reductions that we need to do. So energy is still really big, but if you look at investment by vertical, it is actually lower than transportation. So what this tells us, that between those two things, is a lot of people are trying to create energy solutions to solve energy problems. It is big, but capitalists or venture capital or other funding agencies, including hedge funds, investment firms, they're not looking at it as much as they are for transportation. So when you see this is a great indicator of if you're still at that kind of stage, like, well, should I be focusing this as an energy play or should I focus it as a transportation play? So for example, if you're doing micromobility, you can say, well, actually, we're doing this because it's zero carbon, clean energy micromobility. Well, you might say, well, actually, just put that in my narrative down a bit lower and talk about this as just a pure play transportation issue. And so you can use these kind of statistics to drive or to understand how you position your value proposition for those funders. Similarly, for agriculture, food, and land use, so ag tech is really big, but I found this was interesting that it's actually quite a bit lower than other areas, and this is because, and we'll talk about this in a minute, it's because of other economic things that are happening. But industry was gaining in prominence in terms of investor interest. So yeah, cool, David, I'll come to you in a sec. So this is interesting because I'll cover this in a minute, but it's a lot to do with interest rates. It's a lot to do with venture capitalist firms firming up their existing portfolios and buttressing them rather than going out into others. And industry has a major issue with compliance because of incoming rules around carbon. So industry is worried, and therefore there's a driver for it. Yeah, David, there's a question.
Yes, thank you. Those numbers are globally, North American, Europe?
Global.
Global. So
Yeah.
might not be 100% reflective to Australian investors. They're always a little bit different to the rest of the world.
Correct. That's absolutely right. So slightly different, maybe slightly different here. This is a global picture.
Cool. Thank you.
And so it's a good point though, David. And so it's worth, when you're talking to, even when you're in initial conversations, we can ask this to Monique later. It's like, well, where are you guys interested in investing? Is it energy versus transportation, food versus industry? What are you guys looking at? Yeah, cool. Hamza.
Can you guys hear me?
Yes, we can.
So my question is that when it comes to venture funding, before Tesla's success, there wasn't much interest in electric cars, for example. Right now, there is a huge industry out there. So how to deal with that? Like how to be where the ball is going to be rather than.
Yeah, great question. And people roll that line out a lot about the Wayne Gretzky. You know who Wayne Gretzky is? Famous ice hockey player from Canada. And his point was, always skate to where the puck is going to be, not where the puck is. And it's a famous quote from Wayne Gretzky, and he was amazing because he was a small guy. He wasn't a big burly hockey player. He was a small guy, but he played so skillfully. He understood the game so well, and the positioning of the players in the puck. He was able to run rings around everybody. It was this special talent he had. But the point is, yes, you're absolutely right. How do you know where it's going to be? We'll come on to that in a minute with the first of a kind stuff that investors are looking at. The truthy answer is it's very hard. And for a long time, Elon Musk went around with his cap in hand asking for money before Tesla got anywhere. For years and years and years. He made the money from PayPal, and he still was going around trying to get cash for a long time. And if you think about it, it's 2008 when 2007 when the first Roadster came out. 2007. So we're talking a long time ago. Was that 18 years? Something like that, 17 years. So we've got a long difference between when you get that initial, some super prototype kind of interest to anywhere, I mean, mainstream adoption now for sure, but that's a long time. So the answer to the question is, I don't have a simple answer for it. You have to look at kind of broader aspects of it. Someone? Yeah, sure.
I know. I was listening to a book by Jeff Bezos, obviously the founder of Amazon, and I think he had a really good saying that is probably a really good answer to this, is you want to find what's going to be relevant in 10 years' time and what those truths are. So when he brings it back to Amazon, he says, I can't imagine in 10 years' time, people are going to be saying, hey, I wish there was an online store which was more expensive and had less variety. So his two tenets are always have the widest variety of stock at the cheapest possible price, and that'll always hold true in 10 years. So I feel like that's a kind of a nice truism. Think about what's going to be true in 10 years' time and what that thing looks like, and imagine if you were to apply that same logic in 10 years' time, are people going to still want cheap stuff and a wide variety of stuff available through e-commerce? And I think that's true in 10 years, just as what we're working on now.
Yeah, that's a really nice example. Thanks, Chris. That's awesome. Yeah, really good one. Maybe it flagged something in my mind when I went through an accelerator, international accelerator. The first exercise we did was, what are the tailwinds that mean you're going to get an exit in 5 years' time? So what are the trajectories? Trajectories are clean energy. Trajectories are increasing costs. Trajectories are climate impacts. What are those things that sit behind you that mean your thing is going to be important in 5-10 years' time? Very nice, Chris. Thank you. Rolf, do you have a quick question?
Yeah, talking about headwinds, on climate management, I attended a major seminar at Deakin University with ESIC and international guys, etc. And it became very clear to me that, in business ethics, if you want to avoid certain outcomes, you change the parameters with which you are measured. And so in that regard, I think all the reporting stuff has been there as a slowdown. And so there's a huge vested business interest sort of blowing into your head, where you have to be, in my mind, enormously careful in terms of how you actually position finding a massive solution for which perhaps industry isn't ready yet.
Yeah, okay, that's a good point. So regulation is a huge driver of this, because people are very worried, and we see regulation coming. And the challenge is trying to figure out what that regulation is going to be and whether it's going to change. Are there inexorable bits of regulation that don't change and some that do? So
we have gone really from green washing to green hushing.
Yeah.
So in the moment we are at this sort of point where business is saying like, oh, okay, I have this pledge towards net zero, but I no longer really know how I get there, because carbon credits are getting more expensive, etc. So if I come out now and say like, hey, listen, I can actually at any given point in time tell you what's coming out of the power point in your wall socket and show you it's 65% brown coal in the case of Victoria, I may not have a lot of friends out there.
Yeah. No, that's true. It's so I think you're right. There's a nice chat going on in the group chat here around understanding you're getting the shoulder, so understanding you're not missing the wave that's coming through.
Yeah.
Here's the challenge with these kind of things around regulation and where things are happening. It's that these are the bets that we have to make in advance. And so, for example, on carbon markets, the bet was 20 years ago and building companies, but they also went through a massive dip and had to survive. And very few companies actually survived it through that dip. And so this is the same with the energy space, like it's been up and down. And clean tech's first kind of wave was the late 2000s. And then the global financial crisis came and it just killed. And there was a few sort of, I wouldn't call it a scandal, but it was controversial, was one of the Obama investments from the government. It looked like the government had picked the winner. I can't remember the name of the company. It was a big solar provider in the US. Anyway, it didn't survive. And so it was, and then of course, politically it gets really difficult. So anyway, yeah, you're right. But I like, Chris, what you said there, getting on the shoulder of the wave.
Yeah.
How do we understand
I like that?
Yeah, that's a nice way of saying it. How do we understand what that is?
It's
on the fringes. It's on the fringes.
With the shoulder of, I'm a bit of a cheater when it comes to surfing, so I'm pretty good at reading where the waves are. But there's guys, especially like if you're out at Bondi, and they'll just know the exact pocket, and that's because they're probably surfing there all the time, and they know what little bit of reef it's going to come off. So point one, you got to get yourself in the crowd. You got to find where the pocket is, and you got to just hang around them, and then you watch where they're taking off from, and then you kind of paddle slightly closer to that section, and then eventually that wave comes and you pick it up. So I feel like that analogy for everything we're doing here is like, if you're talking about e-mobility, we'll get to learn e-mobility very deeply, and you'll be in that pocket, and one day something will pop up and you'll be like, wow, that's a niche little problem that nobody else is talking about, and I think I've just spotted something, and that's your shoulder of the wave that's about to come in. Just fucking learn that thing deeply. Yeah, that's what.
There's a nice phrase like proximity means prosperity. You know, so get in the proximity of others who are doing the kinds of things you think are interesting. Let's take one more here, Hamza, and then I'll get to the rest of the stuff.
One thing I read about this that was similar is that look at what is right now and it's been around for ages. Like, for example, we can say for sure that paper books will be there 10 years later as well, because they have been strong. So that's also a way to predict what is going to be there in the future. If you look at what has survived the longest, like Linux will be there for sure.
Yeah, that's true. And is it Selle's law? There's one of those laws that says the rate that's been around the longest, it stays around. The challenge with that is there are that is true, but it doesn't get you in the innovation space. That gets you into great sort of maybe infrastructure investment, but it doesn't answer some of the key problems. So and we do see the shift. So in next books will be around for sure, but the value of book selling compared to the value of e-commerce, for example, will shift. So there's some interesting dynamics there. But can you change a version of that? All right, cool. Let's move on to the next bit. So here's a bit of a picture of what's happening in 24. This is important for us to figure out, to think about. Climate tech funding went through a significant dip 22, 23. It seems to be coming back in 2024. And this is to do with some of the kind of core aspects that are happening in the economy anyway. So this is CTVC statistics. Yes, believing that this is their survey of key participants. Yes, believing that there's going to be the reduction in interest rates, policy changes, increasing public concern around climate change. Yes, will drive more funding through it. There is their divergent point on this is that there's political instability. The election in the US in November has potentially large, significant ramifications around the world, not just in the US, for this kind of stability. And where does funding flow? And it's a good question to ask of a VC, is VCs follow trends. Like, it's not, you think of VCs as being, in general, being the most innovative, the most core at understanding where things are going to go into that puck. Only very few actually do that. Andreessen Horowitz probably, and a few others, but most follow. So when you're talking to VCs, I'm speaking to a lot of VCs, even when you're trying to get around close, they're like, yeah, it sounds really interesting. Who's your lead investor? And until you've got the lead who's willing to take the risk, most won't follow. So anyway, so AI is an important one for there because money is just flowing to that. However, if you look at what's around in terms of dry powder, there are more funds being released, more in 2024 than there were in 2023 by trajectory so far, which is good. And if you look at the assets under management, the AUM for major climate tech investors, maybe major climate tech venture capitalists, they're already getting towards smashing the 2021 goal in terms of the amount of money, the amount of capital with invested in assets under management. So that's important. What it means is there's more oomph than there was 3 years ago, which is critical. And so I think this is actually good news. When I was looking this up, I was like, I'm not sure how this is going, because last year was pretty dodgy. All VC investment went down last year. Climate tech went down less than others, but it all dropped. And there's other reasons for that is that when VCs are looking at this stuff, they're looking for exits. And exits either mean acquisition or they mean material liquidity event like an IPO. And IPOs basically have been frozen for the last year. Very few IPOs, very few decent IPOs. And many of the IPOs that did happen in the 21-22 phase have underperformed. Even Rivian lost 47% in its share value over the last 6 months. Rivian, the amazing US electric car maker, they do SUVs and big trucks and things. Ford is an investor, Amazon's an investor, huge investors, lost 47% in their share price. Okay, so it's tricky. All right. New funds are being raised though, and this is interesting. So the way VC works is you have some smart people who or think they're smart, say they're smart, and they are normally very smart, get together and say, we want to raise some money, we're going to invest in climate change. They go out to rich people, rich high net worths, rich other companies that have got money that they want to deploy and invest in this. They gather a bunch of cash in, and they then, on behalf of those limited partners and those investors, go and make money, invest in other companies. And so the ability to create new funds is an important indicator of the health of the financing ecosystem. So are there new funds being made? Are individuals going out there and raising money and getting a pot of $1 billion to then go and spend? Now, dry powder. Has anyone got an understanding of what dry powder is? So it's from the old days when you used to fire muskets and cannons that had to have dry gunpowder. And so your ability to engage in naval warfare, for example, was a function of how much dry powder you had and the amount of cannons and ship and all that kind of stuff. But dry powder was key, because if your gunpowder was wet, you wouldn't be able to fire your cannons. So dry powder is the amount of money that is sitting in climate VC's funds. It's liquid capital. So this is an estimate, because you can't ever know exactly what it is unless they will tell you. But about $41 billion of investable dry powder still remains in the climate tech space globally. Now, what that means is $41 billion sitting in bank accounts of investors that has not been deployed. It's not been given to invested in companies. It is important, because it's about understanding that there is capital there that's available to you, to others. But the challenge is it's not getting deployed because those VCs and other investors are nervous about something. All right, so it's an important thing to think about. Firstly, number of funds. Yes, there's interest in the sector. Good. You're not in a sector which is declining in terms of how people are viewing it. They think it's important. The challenge is money's going into it, but they don't know where to deploy the money effectively. And here's the second part of the challenge. The majority of this new capital was in 22 mega funds. So really large funds who are looking at investing in large scale deployment of capital. So they're not interested in the 50K. They're interested in the $500 million or the $50 million or the $10 million into an organization. And so I'm doing some work with City of Melbourne at the moment on another piece of work on climate ecosystems and investment. And some of the key challenges there are for Sydney and Melbourne, and especially Melbourne, is getting the size of the rounds and who's getting them. And what's tend to happen is you can see the amount of money goes up, but it's only in 2 investments. And so you can see in that context, you've got 2 really good companies who are getting invested in, everything else is dying. And this is my next slide will cover this a little bit. Was there a question, David, on that? No, okay.
Nothing important.
Oh, well, okay. Well, all right. So I think this is interesting for us here. So the mid-scale funds have been declining in size in terms of capital being raised and new numbers of those funds. But we can see here that the middle bit is challenging, because we've got VC to cover early stage investments. We've got VC to cover very late stage investments, but there's very few VCs who are investing in the middle right now, which is that challenge between going from startup to scale up. So that's good for you guys as early stage entrepreneurs. This comes back to the first of a kind in your questions earlier, Hamza. There is a hesitation to invest in folks, they're called first of a kind innovations, because the risk is too high. So this is a challenge for anyone who is thinking about a fundamentally new technology or fundamentally new way of doing something. However, there is money going into sustainable aviation fuels, for example. There is money going to methanol. There is money going to hydrogen. That's dropping now, but there are still interesting things happening. We'll cover where the money could come from instead, which is probably government funding instead. One of the challenges with the funding cycle when you're looking at VC, and this is maybe down the line a little bit for you, but it's worth thinking about, is yes, okay, we can get some early stage investment. It's actually getting that second, third round that are actually really hard, because that's where they want to see you've got traction and you've turned it into a product that's got market commercialization and funding that growth. And that's where venture capital tends to get a bit nervous, because it's the hardest stage. We'll cover that in a moment. So why? So there's the missing middle. The second challenge is the wait and see for deployment. So as I've kind of just mentioned, dry powder and deployment aren't linearly correlated. So you might have a lot of dry powder, but not deploying. You might have, such as in AI, AI at the end of last year scrambled to deploy capital because it's a hot market. And so then people are looking for dry powder. They're looking for funds so they can stick it into AI before everyone else can. In climate tech, it's not like that right now. They dropped last year, but that's normal because everything dropped last year. But what are the problems? Valuation risk adjustments. So what can happen, and I've experienced this in our own company. You go out with valuation at a hot time in the market, you get a good valuation. You come back 2 years later to raise capital, you get a bad valuation because you either haven't done what you said you were going to do, or what you could do because of lots of different factors, and we can talk about that in a moment. Or the landscape has changed, and that's not a hot topic anymore. And so what that means is you go into what's called a down round, which means you're going out to try and raise capital at a lower valuation than you had before, and it just looks terrible to everybody. So, so valuation risk adjustments, what that means is as interest rates go up, the cost of capital gets higher for startups, and the risk profile of an investor changes. Because if you can make 6 or 7% sticking in a bank account because of interest rates are high, then your propensity to go and take that and put it into high risk capital to maybe get 10% isn't so much. Whereas when you're during COVID and your interest rates are at 0.5%, there's a great time to raise money. Yeah. Okay. The other one is the stagnation of IPOs. Initial public offerings wasn't there, so there's no exit event. And there was the worry of course, increased interest rate hikes to stabilize the economy. So what happened was, especially in climate tech at the end of last year, maybe this changes this year, but not so much, is they've made investments in large sort of keystone companies in the middle. So like, you can imagine a charging infrastructure company. The only investments they were making were investments that would support that keystone company. So they either were not making new investments either side of that and just keeping that one they've invested in really healthy, or they were looking for other companies that would support that initial keystone investment. And so what that means is you tend to get agglomeration of investment around specific kinds of companies or a specific company and you can only really get some capital from that venture firm if you are supporting their golden child, essentially. All right. On the chat, what is cost of capital? What do you think cost of capital? What does it mean to you? So sticking to the chat here, what do you think? What does cost of capital mean to you, and why is it important? It seems stressful. Okay, good. Equity. The money you pay for money, yes. Yeah. Cost of capital. So, yeah, okay, good. I like it. All right. So what you guys have put in there are all correct. And you've nicely identified the two sides of the cost of capital. Firstly, cost of capital is how much do you pay for it? How much do you pay for that money? So you go to the bank, you take a loan, your loan is 7%. That's your cost of capital. So that's your cost to get that capital in. You're going to pay 7% back on top of it. High cost of capital, mortgages, all that kind of stuff. That's how you pay for it. So when you go to a VC and you're asking for money, the cost of capital is how much equity you're going to give up. You covered that as well. So how much are you willing to give up of your company so that in the end, when you exit it, you don't get that. So you go to an investor, you own 100% of your company right now. You go to the investor and they say, great, we'll take 25%. Okay, for how much money? 50K. It's like watching The Dragon's Den. Whenever I watch that, I'm like, this is ridiculous. Here's 25K for 42% of your company. The cost of capital is extortionate. However, and this is where this all gets very stressful and difficult, is people then say to you, well, you know, there's no point in having all of the pie if the pie is tiny or doesn't exist. You might as well have a small slice of a much bigger pie, which is true. The challenge as an entrepreneur is figuring out where you sit in the middle. So that's the cost of capital. But you also correctly identified here the control of it and the stress that comes with it. So the cost of capital is not just how much money you're going to pay for it. It's what do you give up for your business and who you are as the founder of that business. So the cost of capital is they take control. I also know VCs who say, we're going to give you this money. These are large VC firms. We're going to give you this money, but we're also going to install one of our people as your CFO. So they'll give you $2 million, but as part of that $2 million, that money goes to pay for part of it, a new CFO who comes in, chief financial officer, who then governs the finances of the company. Yeah, exactly. So that gets into a bit of a challenging situation when it's your company and suddenly someone else is telling you how much money you can or can't spend. However, if you are struggling with that, you could have a very good outcome because suddenly you've got someone who is investing in you, who is backing you, who believes in you, but wants to see you do it well from a financial point of view. So that is the cost of capital. So how do we figure out a good way to deal with capital at the beginning? Look for different kinds of capital. So the best funding is free. Who gives away free money? Well, it's never free. You have to write reports, but the government grants that come without strings attached. It comes with painful reporting requirements, and it can come with painful application forms and low success rate. However, if you're in a hot topic like you guys are all in, you are in the right place to go and find some money like that. So we'll whip through this, and I'll give you a quick story of how things I've been through, and you can ask me questions on that. So the second one, okay, cost of capital, which is not a real term, but it's one I think about. It is okay. Accelerators and incubators. You're going to give away equity because you're early stage. You're going to give away a reasonable amount of equity, maybe even 10%. And you're probably going to get a bit of cash, maybe 50K, maybe 20K. And you get part of it, but you get part of an accelerator or an incubator that supports you grow the company. Okay, cool. So money and support, not bad actually, when you're really early stage. The other one, 3 Fs, friends, family, and fools. Now this is when you go out and you say, I've got this cracking idea. All I need is 20K to get it up and running, and it's a guaranteed win. Everyone's going to earn lots of money, and your family goes, all right, Adam, here's $1,000. Do your best. All right. Friends and family and fools, go out and do it. So friends and family, right? They do it because they believe in you. They're probably not doing it for a return. I'll tell you a story about that in a second. Fools it's not a very fair way of calling it, to be honest. It's just it works with 3 Fs. But fools in this stage are called people like technical advisors, people who are willing to give some money potentially, but also give some time, expertise to support you in your growth. So it's not very fair to call them fools, to be honest. The reason they're called fools is because they've not done probably there is not a proper risk profile done on your company, because there's no way to do a risk profile on a company because it doesn't really exist. And that's why it's called that. So they don't love you as their family and friends do, but they love your idea. They think you're great. They're going to put something in. Rolf, you had a quick question?
Yeah, I think I understand the notion there, but I think interested in your view, because there are quite a few non-equity investors out there, but they do require you to have invested some of your own money. So my question then really is, are those fools actually the ones that can help you to demonstrate to those non-equity investors that, hey, listen, there's 2 million in here already, so will you match the 2 million, for example? So wouldn't really understand the notion with the 3 Fs, but I think that can be crucial.
Yeah, I would probably put that under philanthropic patient capital.
Yeah, any patient, that's a good point. Yeah, patient capital is better. Yeah.
Yeah, and so they will take an equity stance in the company, but they're not driving for that 10x exit within 3 or 4 years like a venture capital firm is. So they would probably come under a slightly different kind of category of large scale, like family office investors. We should talk to Monique about this in half an hour, because she is managing a bunch of work for family offices as well. They're actually very good for early stage climate work, because they're not looking for that super fast return, and they are different buckets.
Yeah, but I mean, you know, I think then, like, you go patient capital, not necessarily equity, I would think. I think there are more modern financial instruments now. Then you go into the next stage, where again, non-equity funding, who are prepared to double your 2 million to 4 million, but then they don't have the next 10 million, and they're quite happy to exit there. So, but maybe it's for me unique. I'm very interested in those stepping stones where you don't give up equity too early. That's all.
Yes, yeah, absolutely.
Can I chime in, Adam?
Yeah, sure. Just one thing on that though, just with those moments when you're going through and finding non-equity, is there's R&D tax grants, there's government grants, but a reasonable amount of that requires matched funding.
Yeah.
So can you find someone to match your funding? But that's true. Yeah, Chris.
I was going to say, like, I find the conversation around equity funding when it comes to startups, and I've been through Launch Vic startups and different accelerators all over the shop. It kind of grates on me after a while, because it's actually the hardest form of funding to get. Like, it is the worst. If you're going to go for start, mate, you've probably got 500 applicants for 10 positions. Do you know what I mean? And they're looking for everything soft drink to robots. Do you know what I mean? So, like, within this vertical of sustainability, it's not as fun and exciting as everything else, but it's very deeply needed. And I find it, like, for a while, like, whenever I hear VC and funding and conversations about equity, I kind of, like, my eyes glaze over, because it's like, it's the hardest. It's like saying we're going to launch a rocket and go to the moon tomorrow. Like, it's that hard. So you're actually much better trying to find customers to pay you. I promise you, that's the easiest way. And in doing that, you'll build a better product. So if I was going to give any advice from my experience and all the stuff under the hood I've done and all the different networks and everything else, like, VC is like your last option on the table. They're like the meanest form of bank you can find. They are ruthless banks. That's all they are. So find customers. That's my best advice to everybody on this call.
I agree. So I agree. They can be absolutely ruthless. Very difficult organizations to work with. The challenges, I agree with you. Find the customers. If you are doing something that is a first of a kind, you're going to need support to get there. Who gives you that support?
Yeah, so, like, I know Health Systems, for example, and they do commercial. They were one of the winners of this Launch Vic thing with us as well. They've raised $800,000. Now, they did that because they already had a friend that they'd known for a long time that was already willing to go in with them as a partner on a $600,000 grant, and they were able to stepping stone off that to get another $200,000 grant from the government. That's very rare. They happen to have a long relationship with somebody who was high up in the building industry that already believed in their concept. So they came with a wealthy investor by their side. That's the exception, not the rule. So and into their business as well, like, with that funding, they're still trying to get revenue from the door. Like, the first few projects are really just like case studies where they're not earning much off it, getting some data. So I agree, there are some instances where the businesses kind of can't launch until you get startup funding. But I think if your whole modus operandi, if your whole business plan relies on getting a VC investor through the door, you might be waiting for a very long time. That's right. I promise you now, like, it's not like this. I hate this conversation, because it's always made out to be like, oh, that's fine, I'll get a $3 million investor and they'll take 20% and put somebody on my... No, it doesn't work. It's so hard. I promise you now, if I could have figured it out, I would have already done it. And I'm not an idiot, and it's not that easy. And I've spoken to multiple VCs and family offices and KPMG. It is not that easy. So I take all of this with a grain of salt, is what I would say to anybody. I don't want to crush everybody's spirit, but this is the hardest fucking thing you can do.
But we aren't we saying the same thing? Like, you know, that there are alternatives to equity, and you can ride the wave of getting your, once you have funding in there, you can ride a wave of scaling it up by getting people to double your funding. And there are people that will double your funding and then are willing to exit because they're not there to, you know, go all the way for you to become a unicorn. But I pause there, and I understand Monique will answer.
Yeah, I'm just reflecting on how I feel about this conversation at the moment, because I I think there is, I actually get your point, Chris, it is a very difficult conversation, because normally it's talked about as an absolute, just go get the VC funding. But I also know the journey, and there's different ways through it. So maybe that's a way to think about. Hamza, I'm going to pause your question just for now. I'll talk you through a quick timeline of how, when we raised capital for our company. So and if this is helpful, shall I go through the story and the timeline of capital breaks and all that kind of stuff? Okay, cool. So we started Regrid in 2018. We got into, for a year, we did work on it with no money, and then got into an accelerator, got into Startup Bootcamp, which is at the top here. And we got $20,000. We gave away, I think it was like 4% equity, $20,000, and we got into the program. We did the accelerator. The ambition of the accelerator at the end of that is for everyone to go out and raise $1 million from VCs or other funders. We did a couple of pilot projects, not much revenue, very hard to get revenue. It was very much an idea and a good team. Then we went out after that, and we raised just under $1 million on Virtual as a crowd equity platform, which was at that point one of the hardest things we'd done to try and raise capital.
What was the cost of that campaign?
$50K.
Yeah, and I'm hearing on average 150 these days, because money's much tighter.
Yeah, so it's getting harder. Virtual is one of the more expensive ones now as well. But the cost on us, stress, and to do that was significant. That was, it's quite a bit of stress to get that done. But we got some money in the door. Then we closed a round from Mirvac, the property developer. So just a small amount of money on top of that to top us up. So we basically had $1 million to go and do the work, which was good. And we then sort of hired some people. We went out, we tried to create product. We had this great vision and great approach. We couldn't get traction. So went through COVID, slashed our salaries. We're on low salaries as it was, slashed our salaries down, tried to survive, tried to get some pilots, got some pilots running, did some pilots with Mirvac, did some pilots with, was there another energy company? I think there was. We got close to doing some pilots with some big other energy companies, and we just kept kind of flopping at the last moment, not able to deliver the product that people wanted and actually sell to get revenue. So got into a global accelerator, another one, which is really good, which really helped us, zero equity. That was the YPO A+ accelerator. That really helped us kind of refirm value propositions. Went out again after that to try and raise some funding, was unable to raise some funding. In 2021, we always had an approach to raise a not-for-profit, put together a not-for-profit crypto company and raise crypto on this, because we were basically running on the blockchain. Went out and did a crypto round in 2021, full scale, initial decentralized offering. So full crypto round, full stress, awful, just terrible. Raised $2.8 million US, spent 1.6 on the campaign. Now, absolute carnage, so hard. Why were we doing it? Because we believed so vehemently in what we were doing for the world and what we were doing for ourselves, and we wanted to do it. We wanted to drive these companies forward. And so we did that, raised the money, hired people because we thought we could use that money, hire great people, hired some amazing people to solve the product market fit problem, and we just couldn't get there. There was no product market fit. And so and funnily enough, then we came to basically, tried to raise another capital round 2022, couldn't raise it. There wasn't enough traction. Markets were downturning. The crypto market collapsed. Everything went against us in that time, so we couldn't raise the money. So therefore, basically, it was 2022. We sort of we had to shut the company down essentially. So we shut them both down. Now I say not me anymore, because we shut the company down. I stepped down as the CEO of the company. The co-founder wanted to take it over and do more AI stuff. So essentially what happened is we shut the company down, but we didn't close it. So all the investors still had their investments in it. And we split the company, and now Microsoft came in, wanted to scoop it up and do some work with it. So the company is doing some work on AI and climate and energy, which is really great. And that's one side of it. And the other side, the crypto side, we stripped right back down to basically nothing. no spending, no nothing. And the director and I, because we're still directors in this, started building it back up from the bottom. And all we focused on is, can we get commercial contracts for the work we provide? And now we're getting commercial contracts. And so now the company, with very little action and very little capital, but enough to keep it sustained, is winning work. And so what's interesting about this is that, and this is why it's not linear, and it's not one thing supports one thing and one thing isn't. So it's not that all VC is bad, it's not that all crypto is bad, it's not that all just straight revenue is good, because what can happen is if you just get into revenue, you can end up just limping for a long time. So it all depends on the circumstance. What I found from this is, my one reflection was, it was actually very good to go out and create the entities and raise some money. It's a good thing. What is not so good is not having a solid product and a product market fit that really is solid, that you can generate revenue on, that you have got customers on before going to get that money. That would have been better. We just would have focused on that as the lever point to go and get the money, rather than just the story. Anyway, that's the story. I'm happy to take questions on or thoughts on that one.
Just to finish on that one, and that's probably more my point. I'm not saying we won't be in a position one day where we try and genuinely raise some money, but I think a lot of people, and from all the traps I've seen, especially people who are new and thinking, I've got the startup idea, the first thing they think is, I've got the startup idea, I'm going to go out and raise some money, and then I'll solve all my problems from there.
Absolutely.
And I think if you had taken if you maybe had been less focused on the startup capital and more focused on how can we just get on by with the smell of an oily rag, and really think deeply about what we're trying to solve here and how we're trying to do it and get our systems in place, when that money came in, that would have been far more of a moonshot than what it was in the reverse, where it's like, hey, let's get some money and then we'll figure it out as we go. And I think the chances, especially in this economy, of getting money on the whole, like, hey, here's my idea and we'll just figure it out as we go, is like very, like, you lucked out when money was flush by sounds of it, because it just is not floating out there at the moment.
That's
I would, if I was talking to my former self from 2 or 3 years ago, I'd say, don't focus on startup money, just worry about building a good product and at least trying to get the bones of an idea up and running. Get a side job if you can't afford it, get some other way of getting money through. Don't rely on the idea that some big investor is going to come in and scoop you up and solve all your problems. It's the opposite. Solve your problems, then go out and get some money second.
Yeah, you're absolutely right. More money, more problems.
I would just say.
Yeah, Hamza?
So I would just add to the same thing, that it's better to start with consulting and building the product on the side, because with consulting you can always make money, and it will tell you how much skill set you have.
Yeah.
Because at the end you will have a viable business, even if your product is not there. It doesn't generate money. The problem I feel, and I agree with that, expecting other people to fund your ambition is, imagine if somebody walked to you and asked you for money and say, look, I have a great product idea. It's going to make millions of dollars. Are you willing to invest $1,000? You will think twice. Or I don't know, most of the time you'll just say.
I agree. Both your points are absolutely right. And the 2 companies I run right now, we are only focused on commercial projects. Is there something happening that's going to pay us money? At some point, we might take more investment, but right now we're not interested in it at all, because it comes with so many other problems and challenges.
And I've seen, like, I follow companies a lot, and I've seen a lot of companies coming up with great products, because when they're doing consulting work and they see, I used to work for one company in Pakistan. They do that all the time. They do projects for banks, and they realize, oh, this is a same problem that other banks have as well. So their project will become a product. What they didn't do right is that manage their products properly. Otherwise, they would have very viable products. But it's like when somebody is paying you to do something, that means they're paying customers for it. And if you package it as a product, you have a winner.
That's right. And you're absolutely right. You can package it as a product. So you turn your consulting service into a product. Fantastic. It does come with product issues. And Chris, you're right as well. The cost of capital is much higher now. The competition is much higher. So if you don't have an MVP with someone who's paying for it, it's very hard to convince someone to come up and part with some cash. And this is why this program, we focus so heavily on problem solution fit and MVP creation. That's a key bit. All right, I'm just going to go to this. I'll pause for this because I want to get through before we get Monique coming in. So pause your questions for now, but just quickly, I'll send these afterwards. Here are some links to these organizations as well. Now, I think accelerators can actually be very useful, but as Danielle put in the chat, if you don't have a product that someone's willing to pay for, all the acceleration in the world will not help you. It might help you refine a bit, but you've got to have something that people actually want to pay for. Anyway, I'll share with you afterwards. We went through Start Bootcamp Australia. I know that Energy Lab does some really good work as well. Of course, the other ones which are low cost of capital are the university accelerators. Just be careful when you're going through these things that they're not just paying lip service because they like you and you're a great and nice person, and actually get down to, have I got something that's going to work? And if they say, no, you haven't, and you still believe it is, that's great. Go out and sell it to someone. And that's absolutely fine. The history of VC is littered, VC and accelerators is littered with stories of passing on an investment. And here's the other one, Y Combinator, arguably the best accelerator in the world for startups. Most startups in Y Combinator do not find product market fit. So everyone talks about Dropbox and Airbnb. They are the rarity, right? It is tough. Okay, so we'll get to this bit here because I want to cover this before we get to Monique, which is in a few minutes. From start to scale ups, we are all very much in this startup stage. There's different barriers to hit there, but the biggest one is the chasm to get to scale up. Startups can do lots and lots of things. It's, as you said, it's the smell of an oily rag. It's scrappy. It's, you're able to get away with more things because you're just servicing a few customers. You can sellotape it together and use elastic bands or whatever it might be. But as soon as you get into that, trying to get into the scale up and actually making it bigger, that's where the problem starts. The real problems begin. And as you go through this from the startup stage into the scale up stage, this is where you will sit. So right now you sit with or1. We're about idea stage. R&D costs a little bit. Okay, cool. Tech transfer. Where do we get in from? We're losing money. All of this. Now this is where, if you have the conviction and the team and really the product you think is going to solve this, and you have some traction, this is where capital is useful, because you may need some capital to get through the valley of death, depending on what you're building. Right? And so the valley of death is very real. There are, I think, I've written about this in the academic literature, that I think there are 2 valleys of death for climate tech. The first one, or there might be just a bit of a dip. The first one is, do you solve the problem? Because there are lots of ideas and solutions that might not actually solve the problem that we need to get through. And the second one is the commercialization, valley of death. Now this is the really, really difficult part. And you can see it's the deepest here. You've launched a product, it's out in the wild, and it's not getting traction, or it doesn't get traction to a certain inflection point. And this can happen for lots of different reasons. Timing the market, it can, many different, regulation, competitors, lots and lots of things. And so when you get to this kind of later stage, and when we're talking about real scale up and moving up to being a sustainable corporate entity, these are very different skills than you kind of need at the beginning. It's rare that we see an Atlassian where, Mike Cannon-Brookes took it from the very beginning and is as successful as a CEO of a major international corporation as he was as a founder CEO. And so these need different skills. And so there are some really important conditions and things to think about when you're going through this. And it is painful. The valley of death it's real and difficult. And so that's why I think it's important when we're talking about surviving and thriving in this landscape. It's very important to acknowledge just how difficult this is. And I think COVID has opened this a little bit. Because the challenges of COVID, people are more able to talk about mental health issues for just in general. But in the entrepreneurship world, there's this mythology of the entrepreneur, of the person who starts it and at all costs will make this a success. And I've had VCs say to me before, I want you to be the guy who breaks in through the kitchen at a restaurant where I'm having dinner with my wife, so you come and pitch me. And that guy is actually a very nice guy. And I'm like, that mythology is very hard, because it's just saying you've got to do absolutely everything to get that capital. And actually, in the end, that is not really what it's about. What it's about is, have you got something that's valuable? Have you got something that's going to be useful? Have you got a right partnership with them? Now, I think he was just giving me an example. He didn't actually mean that, because he's a great guy, very, very smart, excellent VC, very kind. But what his point was there is that there is that mythology there that you've got to go to the very end. And I spoke to another VC who had their own company as well before they became a venture capitalist. And they had to shut it down. They were doing really well. It was in fashion. They were doing really, really well. And then it just started going wrong and getting bad. And then we're getting to the point, okay, we're going to have to take a lot more debt for this. And they were actually a couple. They looked at each other and said, we can't do this. And the company had been running 5 years. It was essentially a successful company, but it had that downturn and they couldn't survive it. And they decided not to, and they pulled back. And they also told me a story of a female entrepreneur in the fashion industry who had gone through everything. It's in Southeast Asia, gone through everything, sold their house, sold everything, and was looking into the chasm of absolute destruction, and turned the thing around and pulled it back out and created a success out of the company. I don't have the more details than that. And that was the story as far as it went right before we were giving a panel. But the point is, this is a mythology. And along with that comes significant amounts of stress and mental health issues that entrepreneurs face, and potentially have twice the level of suicide, like high risk of suicide, twice the level of high risk of suicide than people who are non-entrepreneurs. So there is a whole range of work that needs to be done on this. I have a very good friend who did a lot of work on this at Breakthrough Victoria. And in terms of founder wellness, I wanted to flag this because the challenge with being involved and being a founder and identifying as a founder comes with lots and lots of different challenges and ego of who you are and your value in the world and all that stuff, which has to be accepted and looked at not accepted, has to be challenged and looked at as a way to understand how you navigate yourself through this process. So this is really just I cannot do this justice. It's something that's very close to my heart, because for me, it was incredibly difficult going through this stuff. But I think there's a lot more work needs to be done on this. I just want to flag this for you guys. Take a step back. Lots of this can be done in different ways, and definitely there's no one right way to solve it. And when the stress is getting too much for these things, it's definitely very important to reach out, because there are support services around for this right now, and increasingly so. So it's very good. All right. I'm going to come back to this one. Okay, we've got a couple of minutes. No, we've got 1 minute. Okay, so any other questions on what we've covered so far today? Or reflections? Rolf?
Well, when you said, ask the wife, your friend to break through the door and pitch it to your wife, it raises actually a good question in terms of helping your close family and supporters to understand what you're doing. And that can be challenging because if I explain to my family interplay between solar, hot water storage and how the hot water is they struggle with these concepts, hearing it from me. So I actually thought you would say, like, one of the good ideas would be to bring in a third party that says, hey, by the way, Adam's idea actually does work, and you may not fully understand it, but I've been, you know what I mean? Like,
yes, yeah. No, I think what he was saying is, like, he wants the passion and the drive to find a solution to whatever it is in whatever way. He was saying, like, I want you to be able to break down all the barriers to get through and make your thing a success. But you actually raised a really important point, which is you've got to be able to explain it. Explain like I'm 5. ELI 5, right? Hold on, I'm gonna let me just send a quick link to Monique to send some challenges here. We go. There it is. Yeah, so I think if you can explain it really well, someone and they get it, that's a really important part as well. Yeah, okay, cool. Sorry, Hamza. And then Carmen.
Quick, I would be just quick. I think I love listening to your story. So it's not like you will make it or break it. There is always another way, like the way you are operating, like you're in consulting and so it was reassuring that it's not this or that. There is a middle way as well.
Exactly. And I was very much of, it's got to be this way, it's got to be this way, and drive, push. And in the end, it can kill you. So relaxing with it and saying there are better ways to do this. And being in non-VC invested companies right now, not VC invested, no, being in companies that's not the case. I'm very happy to take VC investment. Being in companies that are driving a product that people want and they're paying for is so much more relaxing than driving a product that no one wants. Carmen.
Hi, sorry, I don't have my video on today.
It's okay.
But my question was really around as we're going pitching or for funding and so forth, or just pitching our ideas more generally to important stakeholders.
Hey, Monique. Sorry, can you hear us? Yeah, we can hear you.
I can't hear you. Hang on 1 second. Sorry.
Okay, I'm just taking a question. Oh, hold on. Yeah, carry on, Carmen.
Yeah, I was just wondering whether there's any IP issues or challenges or risks that we need to consider or be aware of during this process.
Okay, cool. That's a good question actually to ask Monique around IP. So yeah, look, my personal opinion is that ideas are worthless. It's execution, it's everything. So, but you don't want to go and give everyone your whole pitch deck and all your financial models and just hand it over on Twitter. But we'll cover that in a moment. So, okay, cool. So look, Monique, thank you for joining us. Can you hear us all right now? Okay, super. So look, we've come to the final kind of half hour of our 6 weeks of training, and you and I kind of talked about this a bit earlier, Monique, but we got a group of people here who are been entrepreneurs before, sold companies before, new entrepreneurs, new ideas, all in the climate tech space. And so this isn't an Ask Me Anything session. I've asked them to be as open and think about the things they really want to understand. So we've just had a question on IP, for example. Could you just give us just your top line kind of history, how you landed here today in like a couple of paragraphs? And yeah.
Sure. Hi, everyone. It's great to see everyone here and very excited that there's more people working on climate tech because we need it. So my background actually started in law, and then since then I've been working in investment and strategy in the US, UK, and Australia. Most recently, I've been working specifically in the climate space with Alan and Carol Schwartz's family office, which is the Trowalla Group. And what we've been working on is developing effectively a catalytic climate funding model, because one of the things that we've found, and I can sort of go into a bit more detail about this if it's helpful, is I sort of went on a bit of a research journey on specifically what the barriers are in the funding landscape for climate tech, because I think, as we all know, we've got a very short time frame and a lot to do, and sometimes there's not the right sort of adequacy of funding structures that are useful for the climate tech, because it's quite different to normal structures. So we can talk about that. And so we've been looking at how we can use different models to kind of catalyze projects that aren't getting the funding that they need.
That's a great segue in, actually, because we've had a pretty lively discussion today around VC funding versus patient capital versus philanthropic versus, bootstrapping. What are your, and Trowalla is really interested in that sense as well. What are your thoughts on where to go to for the money at what stages for that?
Yeah, I think it's having worked in sort of a lot of different landscapes, I think it's quite interesting for the Australian sort of impact investing landscape. We're kind of relatively immature, I would say, in comparison to some other jurisdictions on our journey. So I think that one of the things that we see, and if you ask, a lot of impact investors, is there any trade-off in terms of return for impact? By and large, you'll hear, no, we don't make any trade-off. And I think that absolutely is true in terms of there are circumstances where you can have 100% impact and 100% return. But then there's a lot of other things that are still really great businesses that have impact but don't necessarily meet, VC return hurdles and things like that, or have an appropriate risk profile that attaches to that return. So that's something that gets solved by the market over time, but particularly when you have, we're in a sort of relatively nascent market when it comes to climate. And so there's education and capability and, crowding in of different investment sources that needs to happen. And so we're sort of not quite there yet, where you can cut where the market, I guess, 100% aligns value and profit, in my opinion. I think a lot of people would disagree with me. And so that's why I think it's really important to understand all of the different types of capital that are available to you, but a lot of the VCs that I've spoken to in the last little while have definitely got a focus on climate. But if you sort of look at how much they've deployed, I haven't seen much be actually deployed into the climate space. And there's reasons for that, because the VC model really favors, capital light businesses, SaaS businesses that can be scaled without much, upfront capital. And whilst there are some of the examples of that in the climate tech space, there's also heaps of hardware that has to happen. And that doesn't necessarily lend itself to a VC model. Also, there's long research stages, there's, pilot stages, there's proof that takes years, which doesn't necessarily lend itself to their sort of timeline of, a 10x return in less than sort of 5 to 7 years. So heaps of different options though. I think that family office is a great one. And we're seeing a lot more interest from family office in the space, because I think that they have the luxury of being able to be more patient with their capital because they're using their own money, obviously, whereas VCs have to return the portfolio. That's basically the entire sort of point of their job. I think the other interesting thing that's happening is when it comes to the climate capital stack, there's obviously equity, but then there's also debt, and debt is really important when it comes to capital heavy businesses. So we're seeing a lot more focus on debt. I think it's relatively immature at this stage, but there's businesses like Willamai, which Trowella is invested in, which is really focusing on that bridge to bankability. I would say they're later stage because they're not taking on technology risk, but they're trying to take businesses like yours once they're past sort of that proof point to how do we actually scale this, and so providing sort of finance and debt at that level. And then obviously there's grant funding and philanthropic capital, which is incredibly important, so that we can take into account those positive externalities that have been created that aren't necessarily being valued.
Monique, I'll ask one more question. I mean, just on that the family office or philanthropic approach, because you've looked at this as well. Like, what makes a successful pitch to a family office? Because with these are very early stage, but they've got incredible kind of long-term ideas and horizons here. What does a successful pitch look like? And then what's the one mistake that founders make when they come to you to ask for capital?
Yeah. So I think the really interesting thing about family office is that they're working with different pools of capital within one structure. So normally if you're going to pitch for a grant, you're going to like a grant making function. Whereas if you're going to pitch for commercial capital from a VC, they're completely separated and separate people. The interesting thing about family office is that they kind of have different people most of the time looking after it, but they also have kind of one eye on each camp, which is why I think they're really important to the impact investing landscape. But you have to lead with commercial is I would say my number one tip is that, yes, tell an impact story, and an impact story is really important, but it ultimately has to be a business first. And so that's the key difference between pitching for philanthropic versus, commercial capital. But where you're trying to blend those, which is what impact investing essentially is, it has to be commercial first. Because if you think about it from an impact lens, you're not going to make the impact unless you have a successful and sustainable business anyway. So it makes sense that it happens that way. But I think that's the key mistake that I see. I should say I also sit on the board of RMIT Activator Capital Fund. And so I'm part of deploying their sort of capital, which is into early stage businesses, and they have an impact requirement as part of that process. And that's something we see a lot. We see people coming in pitching a great story in terms of impact, but it's a not-for-profit, really. So I think making that really clear is important.
That's interesting. Okay, so in the US, a 501c not-for-profit goes to get philanthropic funding, no problem, but they can't get capital, like can't get private sector funding. But if you're a private company, you can't go and get that philanthropic capital. So it's also a question of where do you set up your entity? Is it not-for-profit? Is it for-profit? What's the goal?
Yeah, exactly.
Yeah. Okay. Quick, guys, if you want to put questions in, or put your hand up if you've got a question for Monique, and I'll get you out of there. One last thing, when you like for the RMIT, for the activator, when you're thinking about the investments you want to deploy there, how do you convince someone that they've got to have something small and tangible that's commercial now when their idea is so big? And what are the best ways people have scaled that back to that very simplest MVP?
Yeah, that is a good question. It's really important to get that balance because you need to be able to sell the dream. So you need to sell the market size and all of that, but be able to show a really clear path. And what we're looking for is, can you create something focused and sustainable to start with, but then have the ability to scale? It's all very well. And another tip I would say is that often you'll see someone that's got ultimately a very niche, which is a great idea, great business, but it's a niche, but then they're using a market size of, oh, and then we're going to take on, you know, all of leisure athletics wear. And it's like, it's nothing to do with that. You know, like, so be really sort of, don't be afraid, I think, of having a smaller market that is actually accurate. And I think particularly if you aren't going down the VC path, like, because VC, and again, this is something we see all the time in RMIT, there's businesses that aren't VC businesses. Very few businesses are VC businesses, but that doesn't mean that they're not going to be highly successful. It just means that VC's whole sort of fund economics works on the fact that they get $1 billion to pay for the rest of the sort of failures. That's kind of how fund economics for VC works. Whereas a family office or, you know, all of the different investment types are like, and you know, there's a lot in the climate space from a government perspective as well, who aren't operating like that, like CEFC and ARENA is obviously a grant making function, but there's National Reconstruction Fund. They're operating more like a diversified fund. So there's a lot of funding options that don't require you to say, I'm going to be a unicorn, you know, so.
And there's no point in trying to force it if it's not true. Yeah,
exactly.
Okay.
I would say zebra because, you know, that's the unicorn of impact.
The zebra. Okay, I love
The
it.
zebra.
All right, brilliant. Let's go to Joanne and then Hamza, and there's also a question from David in the chat. So Joanne, do you want to go first?
Yeah, sure. Hi, Monique. I think Adam said in the top 4 skills that World Economic Forum that has put up, which was, you know, critical thinking, creative thinking, self-efficacy skills, resilience, flexibility, and agility. Of those skills, like, how would you like to see them being demonstrated in a team environment, whether it's being pitched, you're being pitched to, or when you're assessing from the other side of the coin?
Sure. So just to repeat, your question is about how we like to see those come through in terms of when you're pitching. Is that?
Yeah, like how would you like to see those skills being reflected in terms of, you know, you can say founders would have certain biases that they may not show overtly, and founding bodies could also have certain biases that does not come in the spoken. And it's very hard to uncover. So the question is, from your perspective, how would you like to see those being demonstrated? So that, I think that, like,
so founder characteristics.
Yes, and how do you assess that? How do you what do you see and not see? What do you hear and not hear?
So I think it's a great question, and stop me if you think I've misunderstood it. But I like, in terms of what's important, I think that all of those are really important. Being able to, so I think particularly in climate, advocacy is probably more important than it is in other fields, because you have to, you're sort of entering a market where you have to be able to sell something that's not already like there and realized as well. I mean, it's probably for most VCs, but I think particularly in climate, and it has a lot of intersection with, you know, policy as well. I think that resilience is incredibly important in a founder. I would say, I think it's one of the most important things. And I think that, you know, founders are typically highly sort of, you know, successful people probably don't love failure. Leaning into your failure is, I think, really important when you're pitching, because it's an indicator of your resilience versus like your fail. So I think that that's something that people shouldn't shy away from. Obviously, agility and ability to adapt is incredibly important, because your business will not look the same as it does now. Like, it will change many, many times. And that's something that you know, should be able to speak to, and demonstrate that with situations in the past or what's already happened in your business. I think sometimes people think it looks like a lack of focus, but it doesn't, like, because, I mean, obviously just like changing constantly is not great, but being able to explain why we've made a, you know, material pivot in the business, it is a great thing.
That's a wonderful thing to reiterate there, Mon, like that kind of ability to be honest and own those failures that have happened. It's hard though. It's easier in the US to do that than it is to do that here, right? We've talked about this a few times. Okay, I won't. I'll stop talking. Let me throw it to. I'll take one from the chat. So Carmen asked about IP, and then we'll go to Rolf and Hamza and David's question. So IP, when you go around pitching ideas for funding, are there any IP considerations or risks you should be aware of?
Yeah, well, obviously IP is always a good thing. One of the, I guess, things on the other side of that would be IP is really only worth your ability to defend it. It's very difficult at the early stage. You know, I think everyone will always ask you about IP and, you know, are there patents and are there all these things? But look, I come from a legal background, so I'm fairly biased when it comes to that, as I know how hard it is to defend. And one of the biggest challenges is you don't have much money. And so trying to maintain this, you know, massive IP protection war chest is challenging. So I think getting advice on it early is really important, and there's ways around it to make it more cost effective. But I also think that there's a big issue where people are so determined to protect their IP that they don't test enough, or they're scared to share their ideas and iterate. I think that's a mistake, because as we've sort of discussed, like, it will change, it will pivot. And I mean, it's different if you've gone through a very lengthy research, you know, process. It sort of really depends on what you've created. But I think that the sooner you can get something in market and test it, the better.
And you may find, if you release an idea, that a larger organization says, hey, we've been thinking about the same thing, but we don't have this capability. Do you want to partner? Do you? And so it can open things. Okay, super, thank you. Let's go to Hamza, and we've got a few minutes. Let's be quick on the questions.
So I have two questions. One, what is the importance of having somebody with law background on your team in terms of when you're pitching to investors, signing, looking for agreements and everything? The second one is that BC has a lot of pressure on, like, they're looking for an exit, 10K exit. Does that impact your business? Like, they push you in directions where they just want to maximize the profit, like early exit, short-term gains versus long-term, hurting the business in the long term?
Yeah, so great questions. I think the first one is it's team is important. So it depends what you're building and how much that aligns to, you know, what you're building. But in terms of like having to have a legal background, I don't think that that's critical. That's something that you can get advice on and you can outsource. That said, lawyers could be a great team member if what you're building is related to law, or, you know, they're just great founders. But I don't think it's a necessary skill set in terms of, we wouldn't look down on it if you didn't have it. In terms of the VC model impacting your business, absolutely. Like, and I think that that's a really important thing for all of you to think about, is it's not just about whether or not you can get investment from them, it's whether or not they're the right investor for you, because every investor will have a massive impact on, you know, what your business looks like going forward. So you really want to be thinking about, is this not just someone who can give me money, but is this someone who has the relationships that I'm going to need down the track? Are they going to be supportive? Like, is it strategic for me? Are they adding value beyond their money? Because they should be.
And they become a team member. They're with you, right? Yeah. Okay. A family member, essentially, of the company. So yeah. All right. Thanks, Mon. Rolf? Oh, you're on mute, Rolf.
And here I was trying to save time, sorry. Okay, thanks, Monique. I fancy myself to be in a pocket where I think the product is commercial ready, but, you know, not many customers as yet. So I want to grow fast before people copy what I'm doing. In that scenario, what would be your favorite lesser known debt, equity and hybrid, if you were to pick a few instruments you could happily suggest?
Yeah, so I think that, well, sort of, can I just ask, what are you building in terms of, is it capital intensive or is it software?
Well, it's a bit of both. It's
Okay.
monitoring and measuring, and then
Right.
potentially bringing in technology at the back end as well,
Okay.
which is more capital intensive. Yeah.
Yeah. So, I mean, I think that one of the mistakes that I see in this space, and it's not really a mistake because I think up until this point, it's been a matter of there hasn't been any options, is that because of I would encourage you to think about what that entire journey looks like. And because if you're, you don't want to give away all of your equity now, if you're then going to have to do a massive round down the track, because what we do find in this space, which is really problematic, is that, people have raised a very big seed round in order to build the technology, but then they actually have to go and build these pilot plants, and they have there's a longer path to actually proving the technology than they assumed, and the founder ends up with not a lot of equity at the end, which is not great for investors either, because investors want founders to have enough equity that they are really engaged in the project and want to keep going. So I would encourage you to think about a convertible note structure is something that can be great in terms of trying to, it can convert over time, and that can, there's a few different mechanisms that I think are good, but particularly if you're going for a very large, capital intensive equity round, I definitely encourage you to think about debt. But if you're not proven technology yet, you are going to struggle to get there. So thinking about it on note, I think, is a good way to look at it.
And we haven't gone into safes and convertible notes as yet, but this is something we can share some resources on. Yeah, but you're absolutely right. Sorry, Rolf.
Yeah, no, sorry. I was interested in modern forms of hybrid instruments, and also modern forms of debt, because debt is not debt, equity is not equity, and there seem to be good solutions coming up that look like debt, feel more like equity, etc. So if you have some reading for me to do there, fantastic.
Yeah, absolutely. I mean, I know that's something that, we're working on with the Transition Accelerator, is trying to combine these things in terms of a capital stack solution. But I haven't, and so I think in the next sort of 6 to 12 months, you'll see a lot more of these solutions coming out. And I think that we're definitely starting to see that overseas, which is great. But I mean, I think the closest that I've seen in terms of from a debt perspective are some of the new, green investment banks. But at this stage, I'd say that they're still not taking on tech risk. So there's still that gap there, which is needing to be solved.
Yeah. And probably, there's money in there to try and solve that from governments, university partnerships and things, but it takes so long and they're onerous and also hard to find. But yeah, okay. I'm conscious of time. We've got about another 2.5, 3 minutes together before we wrap up. So let's do a super quick one from Bhagwan, and then from Caleb, and then I'll ask the final question, which is from David. So quick one, Bhagwan.
I would like to highlight few things on the IP. How you will suggest to go for the copyright or trademark as the beginning at the local level, not at the global level? How you will suggest IP protection, because pitching is always being critical, and lots of people are doing the similar things, and it's always being challenging when we are participating into the competitions and pitching. So could you please help us or advise us some minimum cost effective IP solutions?
Sure. Well, I'm not sure I can give you sort of specific IP advice, but I think that there's definitely a lot of, IP lawyers around who are working with startups that are sort of very low cost base to try and help them get that. And as I say, I think that there's ways that you can sort of reserve your IP licensing without actually sort of taking it on, but I can't sort of really specifically give you IP advice. Sorry about that.
It's a good point. It is very case specific. It's also probably not something to worry about too much at this point.
Yeah.
Until it's real, you can trademark something. Danny's put some things in the chat. You can trademark it. You can do some of that work, but you don't have to go down this huge IP route straight away. Thank you, Monique. Caleb.
Hey, Monique, do you have any tips or any kind of standout examples in your experiences of how to approach, funds, family offices, or high net worth individuals?
Yeah, absolutely. I mean, I think that obviously a warm introduction is always the best way to go. They can be hard to get. There's definitely initiatives where, have you seen sort of, you know, there's the giant warm intro that Rampersand's doing each year, which is a really great event to go, and you effectively, it's like speed dating with a lot of different, you know, VC funds as well as family offices. Another great way to go is angel syndicates. They're a lot easier, I would say, to get in front of, and it can be a path to seeing sort of a lot of different family offices at the same time, because that's a way that family offices kind of get deal flow, is by sort of joining some of those syndicates. So there's a bunch that are in the climate space particularly. So there's, you know, Ecocode Ventures, Electrify Ventures. It's sort of, some of them are a little bit more specific in terms of what your actual technology is. Scale Ventures for female founders. And but I think that also there is a big presence at, you know, networking events and things like that, and it's relatively painful in terms of business development activity, but ultimately raising a round is about, got to, you know, pound beat and meet people.
And that was related to David's question, which is how do we get access to family offices if we don't have private school networks? And I think this is the question, like, how do you, knocking on that door, like, what does that look like for you? What's the best way someone can approach you in this as a human being?
Yeah, I mean, I get approached a lot, to be honest, by people. And I think you'd be surprised by how much people are willing to help you to make introductions if they think that there's genuinely a good case there. I mean, I'm a big believer in giving quite strong feedback. And I think, you know, personally, I think that there's probably not enough feedback given in our ecosystem. But I think that another way to go about it is to look at, you know, accelerators and things like that. It is a great way to get a pathway to make those introductions and kind of get a network if you don't already have one.
Thanks, Mike.
Thank you.
Yeah, and it's about just getting some validation, some traction points, that you're not just, you haven't thought about the idea of a breakfast that day and gone to knock on the door. And the other part of it is respecting people's time in terms of have your pitch ready and say, this is what I'm struggling on, and be really open about what you're trying, rather than selling it.
I think that's right. It's having a really clear ask of what you want, and not necessarily just approaching someone and be like, open your network to me, because that's a challenge. Another thing I would say to look at is people that have gone through, for example, you know, Airtree's Explorer program, because they've all effectively put a sign on them saying we're angel investors, and a lot of those people in those programs have a network outside of that related to investment as well. And so an opportunity for you might be able to get them involved as an angel investor, but also then, you know, get their help attracting other investors and co-investors.
Yeah, wonderful advice. Monique, in terms of time, we're going to say thank you. And it goes so quickly, doesn't it? I wanted to say thank you very much. So everyone, can we please give Monique a nice, warm, wiggly fingers round of applause? And thank you. Wonderful. Amazing. Brilliant.
Thanks, guys.
Thanks, Monique. We'll see you soon.
Bye.
Thank you. Bye. Wow. All right. As ever, we run out of time because we've got so much to cover. So I'm just going to bring this up for this final piece, which is we've come to the end of this training session. I know we have 60 seconds to go, but I'm happy to take it a couple more minutes if we want to. Please, can you put into the chat or shout out loud one of your word, your final circle chat word, your adjective that represents how you feel right now?
Refreshing.
Refreshing. Great. Yeah, wonderful. Sad. Can we keep this going? Thank you, Danielle. Well, you know what? Hopefully there are ways to do it. Yeah, happy, ready, energized, better prepared, reinforced, pumped, amped, inspired. I love it. Wonderful. I feel very proud, actually, that we've got through this and got to this stage. And I'm actually, I feel incredibly grateful to you guys. You're the hardcore. It's hard to take an hour and a half every week at lunchtime and do this. And it's really depressing to do this to one other person or to 0 people. So thank you for coming to these sessions. I'm genuinely so grateful. What I find with doing this stuff is you always, like, there's just bloody amazing people out there. Now, And what I mean by you lot, we've gone through, we've seen your lean canvases, we've seen this work you're putting together. It is fabulous stuff that you're building. It really is. It's not BS. It's not whimsical stuff that doesn't mean anything. It is real stuff. And so I'm very grateful to you guys all being here. What happens next? Applications go in this week, I believe, on Friday, right? Please don't wait until, is it this week? Yeah, please don't wait until 15 minutes before the system closes. I guarantee it'll crash. So please do it beforehand. Like, I've done it before, and I've missed a major funding thing, and it was my fault. My company missed the funding application. This was 15 years ago, and I felt awful because the system wouldn't take it at that time. So please get in early. There's a little bit of, if you need 15 minutes to go over your lean canvas, I can do that. I can't give specific feedback on your application text, but I can go over the lean canvas. Okay, that's just because this is the way this is set up. Reach out to me if you have any questions. If you reach out to Henry as well, we are here. One thing that's going to come up, we're going to send you a survey. Please, please, please do the survey. It's only going to be about 4 questions, but it means a huge deal to me personally, and to our company, and to everything we're trying to do, and to make it better. So please do the survey. I really appreciate that. We're going to send that later today. Are there any final questions or comments or thoughts you'd like to share? Anything is welcome.
Adam, one, just check the message I sent you on the chat. This second, I would say that it was an amazing experience overall, and I find it extremely informative. I found it very informational, and I'm looking forward to your book whenever you're planning to write it, or any. Hopefully, it will be soon.
Thanks, Hamza. I appreciate the sentiment. I really do. It's very kind of you. Thank you. Rolf had a question.
Just a quick one. I think you said last time around to really focus on the text in the box, if you will, to just get past the base camp. Does that really hold true? Because that would actually suit me. I don't want to spend a lot of time on presentations and videos and what have you.
Yeah, the information I have from Maureen was make sure the text in those sections is really good. If you've got anything like demos or anything you want to add in a supplementary, that's fantastic. And they will be looked at, but they won't be looked at if the text is bad. So yes, the text is the most important bit. Yeah. All right. Well, reach out to me for anyone. Bator, ping me on Slack and we can set up a time. And other than that, I wish you all the very, very best. And I'm sure we're going to cross paths again. So if there is anything I can do with help with connections and things like that, please reach out, ping me. And other than that, I wish you all the best for the competition. And good luck. We'll see you on the flip side, okay? All right, guys. Take care. We'll see you soon. Bye.
Take care, everyone. Bye.
Beautiful.
Bye, everyone.
Okay. Yeah.
Thanks, guys.